Let me start with a scenario that happens to thousands of tech workers every single year. You're working at a Fortune 500 tech company, let's say Microsoft, Apple, or Google. Your S program lets you buy company stock at a 15% discount twice per year. You enroll on January 1st, contribute $12,500 over 6 months, and on July 1st, your shares vest at a 15% discount. You're excited. You see those shares sitting in your brokerage account, and within a week, you sell them because you need the cash or you're taking profits. What you don't realize is that by selling on July 8th, instead of July 1st of the following year, you just turned a $563 tax bill into a $1,406 tax bill on that exact same $25,000 purchase. The difference. One hidden IRS rule that almost nobody talks about. IRC Section 423C, the Qualified Small Business Stock Holding Period Rule. Before we dive into the mechanics, let me establish why this matters beyond just one sale. If you're a tech worker with annual ESP enrollment across 5 grant cycles, which is completely normal in the tech industry, this mistake compounds. We're talking about $4,215 in cumulative federal tax drag that flows directly to the IRS instead of staying in your brokerage account, where it could be compounding for retirement. And that's just federal taxes. Add state taxes, especially if you live in California, New York, or Massachusetts, and you're looking at $6,000 to $8,000 in total preventable tax burden across a 5-year S participation period. Let's break down exactly what IRC Section 423C is and why it exists. The IRS created this rule to incentivize employee stock ownership plans. The basic concept is that if you hold your ESP shares for a specific holding period, and this is critical, you get preferential long-term capital gains tax treatment on the discount portion of your purchase. That discount is what we call the bargain element. In our example, you bought $25,000 of stock at a 15% discount, so the bargain element is $3,750. Normally, that $3,750 would be taxed as ordinary income when you sell, plus you'd owe capital gains tax on any appreciation. But under Section 423C, if you meet the holding period requirement, that $3,750 gets taxed as a long-term capital gain instead of ordinary income. Here's where most people get confused, and here's where the $843 tax difference comes from. There are actually 2 holding periods you need to satisfy simultaneously. The first is called the employee holding period. This is 24 months from the date the option was granted, which, in an ESP, is typically the first day of the offering period. So if your offering period started January 1st, your employee holding period doesn't end until January 1st of 2 years later. The second holding period is the share holding period, and it's 12 months from the date the shares were actually purchased or exercised. In your case, if shares were purchased on July 1st, you need to hold them until July 1st of the following year. Now here's the trap that catches thousands of workers. You need to satisfy both of these holding periods. You can't just meet one. If you sell on July 1st of the next year, which satisfies the 12-month share holding period, but it's only been 18 months since the grant date in January, you've failed the 24-month employee holding period requirement. That failure means you lose the preferential tax treatment on the entire bargain element. Instead of paying long-term capital gains rates, currently 15% for most tech workers, you pay ordinary income rates, which can be as high as 37% at the federal level, plus 8% net investment income tax if you're a high earner. Let's look at real numbers. Assume you're a tech worker in the 32% ordinary income tax bracket and the 15% long-term capital gains bracket. Your S purchase, $25,000 stock at a 15% discount, means you paid $21,250 and the bargain element is $3,750. Scenario 1. You sell on July 1st of the next year, before the 24-month employee holding period is satisfied. That $3,750 bargain element gets taxed at 32% ordinary income rates, costing you $1,200 in federal taxes. If the stock appreciated to $27,000 in the meantime, you have a $2,000 capital gain. Depending on whether the gain is considered long-term, it is. Because you held for over a year from purchase, that $2,000 gets taxed at 15%, costing $300. Total tax bill, $1,500. Scenario 2, you wait until January 1st of the second year, satisfying both the 24-month employee holding period and the 12-month share holding period. Now the entire $750 bargain element is taxed at long-term capital gains rates. 15% times $3,750 equals $562.50. The $2,000 appreciation is also taxed at 15%, $300. Total tax bill, $862.50. The difference is $637.50 in federal taxes alone. Add 8% net investment income tax, and it's closer to $700. Add state taxes in California, 13.3%, and that difference becomes $100 to $200. This is where the real compounding damage happens. Most tech workers don't just do ESP once. They do it repeatedly. A typical tech company ESP runs 2 offering periods per year. If you've been at your company for 5 years and never thought about this holding period rule, you might have made this mistake 5 or 10 times. That's $5,000 to $10,000 in cumulative unnecessary taxes. According to a 2023 study by Fidelity on equity compensation, approximately 68% of tech workers sell their ESP shares within 6 months of vesting, meaning they are almost certainly violating the Section 423C holding period without realizing it. Now let's talk about the calendar date that matters. If your ESP offering period began on January 1st and your purchase date was July 1st, your safe date to sell, when you've satisfied both holding periods, is January 1st of the second year after the grant date. Not January 2nd, not sometime in mid-January, January 1st. Why? Because the 24-month employee holding period starts on January 1st year 1 and ends on January 1st year 3 at exactly midnight. Selling on January 2nd technically violates the holding period by 1 day. This is not a gray area. The IRS is very specific about this. If you sell before both holding periods are satisfied, you lose the benefit. Let me address some counter-arguments I hear frequently. Some people say, my company's tax advisor told me I can sell whenever I want after a year because long-term capital gains kicks in. This is a dangerous misunderstanding. Yes, long-term capital gains treatment applies to the appreciation after purchase, but it does not apply to the bargain element. The bargain element is treated differently under Section 423C, and it requires both holding periods. Another argument I hear, my ESP shares were only worth a small discount, so the tax difference doesn't matter. Even at a 10% discount on $25,000, you have a $2,500 bargain element. The tax difference between ordinary income and long-term capital gains rates on $2,500 is $400 to $600 in federal taxes alone. It absolutely matters. Let's look at a real case study. In 2019, an engineer at a Fortune 500 tech company, let's call her Sarah, participated in her company's ESP for 3 years without understanding the Section 423C rule. Each year, she bought $25,000 of stock at a 15% discount. Each year, about 13 months after the purchase date, she'd sell to rebalance her portfolio. By year 3, she'd made this mistake 3 times. In her tax filing, she reported all 3 sales as having long-term capital gains treatment on the entire proceeds. The IRS audit identified this discrepancy and reclassified the bargain elements from long-term capital gains to ordinary income. Sarah owed approximately $2,100 in back taxes, plus interest and penalties. This was completely preventable with a simple calendar reminder. Here's the single most important action you can take. Set a calendar reminder for the exact date that satisfies both the 24-month employee holding period and the 12-month share holding period. Not 11 months, not 23 months, both. For an offering period that started January 1st with a purchase date of July 1st, set your reminder for January 1st of the following year, which satisfies the 24-month employee holding period. I recommend setting the reminder for 30 days before and 7 days before, just to be absolutely certain. Second action, review every ESP sale you've made in the past 3 years. If you've sold before satisfying both holding periods, you may want to consult a tax professional about amended returns, especially if the amounts are significant. Third action, calculate your personal bargain element and tax impact. For 15% discount on $25,000, that's $3,750. Your tax bracket difference determines your cost. If you're in the 24% ordinary income bracket and the 15% capital gains bracket, you're looking at approximately $337.50 per sale. Multiply that across 5 years of ESP participation, and it's real money over $1,600 in lost tax efficiency. The bottom line, IRC Section 423C is an IRS-approved tax strategy that tech workers leave on the table constantly. By understanding the 2-part holding period requirement and marking your calendar with the correct sale date, you can save hundreds to thousands of dollars in unnecessary federal and state taxes. Your ESP is already giving you a 15%